Global and Indian markets are in the grip of multiple, even contradictory forces. The S&P and Nasdaq indexes have rallied sharply in 2023, hoping for an end to the rate hiking cycle of the Fed. But the red-hot January jobs data has thrown a likelihood of even more rate hikes. In India, an excellent budget with big capex promise, restrained deficit is getting countered by volatility in the Adani Group stocks and also China emerging as a rival destination. Citi Bank's India Investor Conference on February 7th and 8th, that's today and tomorrow, is thus excellently placed to debate a lot of issues. Joining me from the sidelines of the conference is NC Badrinivas, Managing Director and Regional Head of Markets and Treasury, APAC region. Badri, thank you very much indeed for joining me. That's the first question, really. You know, it looked like it's going to be a mild recession and an end to the Fed rate hiking cycle. What's the Citi view now after this huge jobs data number?
Good morning, Lata, and always good to be on your show. Look, undoubtedly, it was a strong jobs report, and it reflects that despite headlines around some layoffs in the tech sector in the US, the job market continues to be very strong and quite resilient. And what is the implications of that for the market is really the market is now back to pricing in 2 rate hikes. In between, if you recall, the market was trying to think that there'll be one more rate hike and then a pause or the potential pivot later part of the year. But now the market is back to pricing in 2 rate hikes. I guess the key question is, it's of course one data. The US CPI, which is due next week, is another important data that we have to watch out for. As long as the market, there's no reason for the Fed to enhance their dot plots to a higher level. I think we're still in a territory where we're data dependent, but probably we're closer to the rate hikes potentially.
Okay. Well, the CME Fed Watch tool has actually factored in one more rate hike. There was only a 35% chance of a rate hike after this one. Now that has increased to over 65%, I believe. So 2 more hikes is what that Fed Watch tool is talking about. But I'll come to that in a bit. You have now become the regional head APAC, but my questions are going to be more focused on India. Just tell me how India looks from the regional headquarters. Is the Indian underperformance largely because China is more attractive, and will that likely continue?
Well, if you're asking from an equity point of view or
Yes.
currency, let me look at it from an equity point of view. I mean, the whole China coming back, right, or the opening up of the China versus the fact that India already was on a higher valuation means that to some extent that's played out, because we saw the 4 billion of outflows, in YTD, this reflection of that. And therefore, there is likely to be some rebalancing. From a China opening up, that's a real story. And if you look at the playbook that we have seen in other parts of the world, when after the whole deep COVID, there is a reasonable momentum back in the economy, and therefore one would expect a reasonably strong data coming out of China in the coming quarters. And that's to do with the same story that we've seen everywhere: the pent-up demand, the people just starting to travel, and so on. So to some extent, I think the China story is going to play through for at least a couple of quarters. From an India point, it doesn't necessarily change, the outlook, because in an assuming a risk-on world, I think India will get a fair share of the, flows, because we have continued to have a very, very strong domestic growth outlook. Look, even next year, we'll continue to still be the best performing large economy in the world. So I'm not really worried that there is any massive re-look or a re-rating of India.
Okay, so, you asked about the currency, and that is my next question. This Jan, Feb, March is usually a very good quarter for the rupee because export flows come in. Even then, we are teetering towards 82.5, 83. And that's largely because equity flows are not coming in. More than the current account deficit, it is the BOP flows that are keeping rupee held back. What do you think? You think that we are in to cross 83 before some strength comes?
Okay, there are 2 parts to this. The one is the whole dollar story, and then, of course, the relative underperformance, right? INR is clearly underperformed the dollar weakness versus EM since, probably the last 3-4 months. My own view on dollar is that dollar is likely to consolidate and probably strengthen in the near term.
Oh,
till the Fed pause pivot outlook is a lot more clearer, which is going to be obviously data dependent. In that scenario, where probably dollar is going to continue, is probably going to do well in the next coming weeks, I think INR will possibly be a better performing currency versus the peers, but with an overall weakening bias.
okay, okay. So you would, I mean, April is really the more crucial month because the export flows are all done by March 31st. So do you see crossing of 83 at all?
Look, oil is going to be the one on the without an oil breakup higher. I don't necessarily have a very a strong depreciating view on INR because at the end of the day, our current account deficit still is within manageable territory now. And you're right that seasonally April, May typically tends to be not great for BOP, but those are I mean seasonal and there is enough cushion from a reserves to manage some of those. On a more broader basis, it's really oil currently has kind of, as you know, stabilized and in the Brent in the low 80s. Looking at charts, it does look like oil potentially can break even a little lower, but there is also a lot of global outlook from various economists that the demand supply on oil can actually be skewed to make oil go back closer towards 100. Now, with oil market, it's very difficult to predict. A lot would depend upon oil for INR to break 83. As long as oil remains, at current levels and so on, I don't see any, specific depreciating pressure on the INR.
What about this Adani story? Is that, I mean, it's a good 70% off highs, the Adani Group stocks. Is that spoiling the taste at all for FPI or FDI? What's the sense you're getting?
Well, I cannot comment on any single stock, but
Sure.
again, just
I mean the market impact only.
Yeah, but on a broader basis, Lata, if you look at the composition of the Nifty, if you look at the whole India macro story, right, that's across various kinds of sectors, and many of those are like I just said, there's a lot of positive momentum around the whole fact that as we move towards plus 3 trillion plus and the formalization, the digitization,
Yeah.
the number of unicorns you're getting, all those things are not just one sector specific and multi. And frankly, they remain in place and those things don't get, changed in a one month or one quarter, right?
Okay.
So I just feel that, there is a lot of good story that India has at this point in time in the global place. And again, when you look at the growth outlook in Europe, US, and everything that we've looked at, India continues to be the one large, economy which has so many positives going for it. So I am not necessarily very worried about some of recent things to sully the overall macro image of the country.
Time permitting, I'll come back to the Indian multiples problem, valuations problem. But wanted to get a view on the interest rate scenario as well. Do you think that RBI is one and done? I mean, going by the likely hawkishness we will see in the Fed and already seeing in ECB and BOE, what's your reading of both RBI and Indian 10-year bond, for instance?
Yeah, I mean, just looking at I think RBI will continue to be largely driven by the domestic factors, and we expect a rate hike in the Fed MPC and one rate hike for now, and we think that after that will be a pause. We are not expecting a stance shift in this policy. We think that it will continue to be withdrawal of accommodation. Now, from a going forward perspective, core inflation is something which continues to remain sticky. And given the points I mentioned about the strong continued growth momentum, I would think that on the balance, MPC would like to keep its options open till you get more conviction on the trajectory of inflation, especially core inflation. So on the whole, I think the policy is 6.5 is a fair level, probably definitely closer to a neutral level in my opinion. But whether there would be cuts down the line, I think it's too early to make that call, given the fact that you have persistently sticky core inflation and the fact that growth continues to be reasonably strong.
Yeah, cuts at the moment after that red-hot US inflation number is a bit of a tall ask. But let's wait and see. Badri, just to come back to the numbers I wanted from you. You said you're not terribly worried about the rupee right now. And even in the bonds, there is limited. If you can give me a bond range, and more importantly, if you can give me equities, do you think we are going to have equity gains this year? Or is it going to be, just this 18,000 pivot, give or take a bit?
Okay, firstly on the bonds yields, Lata, just to be sure, I did mention that we expect a rate hike in the Fed MPC.
Yes, but I mean the 10-year.
Subsequent.
I mean the 10-year range.
Yeah, but on the yields, obviously the budget was on the margin, better on the supply dynamics. That caps, if you ask me, the near-term, yields for the next couple of months. Then we will need the MPC direction. So we think that, 10-year could be in the range of, 710 to 740 range, but as a bias towards being lower for the near term. In general, what I'm wary about calling for a sustained rally in bonds is that we've seen rally in bonds only when you're in a rate cut cycle, or when liquidity is substantially expanding.
No, I meant rally in equities.
So now the scenario, at least for the bonds, are not that way. So I find it difficult to see, a sustained rally in bond yields. But on the near term, I think the yields are capped, and then we'll see how data plays out beyond April. Coming back to equities, I mean, you're right. I mean, and this is not a new thing, right? I mean, for the last 4-5 months, I think people have been calling for a fact that valuations were quite rich, despite all the growth optimism. And to that extent, the upsides from at an overall index level would be limited. I think that will continue to be a bit that way. More than what happens from a flow, I think it's largely going to be the domestic, what happens to the domestic flows. If you look at it last 2-3 years, domestic flows have been quite strong and have been actually holding up the Indian markets. In fact, most FPIs always look at in the last couple of years to say, do you see any change in the domestic flows? And there, my own view is that despite interest rates probably at these levels, there's still enough momentum from a domestic flow to come into the market that there shouldn't be any reason for a big sell-off. Okay. So valuations have to be a little, given the high valuations, you're probably not going to get substantial upsides on the index itself in the near term. But overall, we're quite constructive on the returns from equities over the next year or two.
Okay. On that optimistic note, Badrinivas, thank you very much for joining me, and have a great conference out there. Well, that's it on this edition of It's the Economy. It's time for Chartbusters.